The stock market is currently closed today on Saturday, June 20, 2026, so we are looking at the final numbers from the latest active trading session. Because Friday, June 19, 2026 was a federal holiday for Juneteenth, the major exchanges were dark, meaning our most up-to-the-minute data comes from the close of Thursday, June 18, 2026. Lucid Group Inc., trading under the ticker LCID, finished that active session at exactly $5.36 per share. This represented a decent short-term upward move of 4.28% for the day, with the stock bouncing between an intraday low of 5.005 and a high of 5.420 on a total volume of 15.86 million shares. While that single-day green candlestick might bring a momentary smile to casual observers glancing at their portfolios on popular investing sites, the immediate insight that most retail participants completely missed is unfolding behind the scenes in the legal system. A massive class action lawsuit has just solidified a strict court deadline for July 28, 2026, targeting the company for allegedly hiding a damaging 29-day delivery halt of its flagship Gravity vehicle due to defective second-row seats. This hidden operational freeze caused a brutal mismatch between executive promises and actual retail distribution, creating a profound gap between market perception and corporate execution. When most people look at a luxury electric vehicle player like Lucid, their expectation is shaped by the sleek designs, the engineering prestige, and the seemingly bottomless financial backing of sovereign wealth funds. They view the stock as a coiled spring, a high-tech challenger that could eventually mirror the historic upward trajectories seen in Tesla stock or Apple stock. People opening up a retail individual brokerage account or using a modern app like the popular Robinhood app look at a $5 stock price and think they are getting an absolute steal on a luxury brand. This collective expectation creates a strong buy-the-dip narrative across retail communities. The underlying reality, however, presents a starkly different story, marked by steep cash burn, deep operational missteps, and severe institutional skepticism. When you inspect the raw financial statements rather than the glossy marketing brochures, you notice that the company recently reported first-quarter revenues of just $280 to $284 million, completely missing the consensus Wall Street analyst expectation of $433.8 million. Missing a top-line target by roughly $150 million in a single quarter, while operational losses approach $1 billion, indicates a massive structural headwind that no amount of smooth body lines can easily fix. This widening gap between what investors want to believe and what the hard data shows has triggered intense volume swings and heavy repositioning among institutional market makers. If you look at how active traders manage these positions via high-tier setups like the Interactive Brokers platform, you can see large blocks of shares moving as institutional participants hedge against future equity dilution. The anxiety peaked earlier this month during a highly contested shareholder meeting where management sought approval to issue an additional 23 million shares. For a typical self-directed investor managing a personal portfolio through an ordinary individual brokerage, equity dilution sounds like abstract corporate math. In practice, it acts as a heavy anchor on the share price because it splits the future earnings pie into much smaller pieces. This dilution anxiety explains why the asset has lost more than half its value since the beginning of the year, sliding from over $10 down to the current $5 handle. Retail investors using basic self-investing accounts frequently check their mobile dashboards hoping for a sudden squeeze, but institutional investors utilizing professional interactive broker stock trading tools are focusing much more on the structural supply of shares entering the open market. To truly understand how this asset moves, we must look at the broader landscape of modern retail asset management. Many retail savers seeking hands-off investment help are putting their capital into automated systems like Schwab Intelligent Portfolios or various automated options on a modern intelligent portfolio platform. These algorithmic systems look at volatility metrics, debt-to-equity ratios, and cash runway rather than product type. When an algorithm scans an automotive startup burning through billions of dollars of cash with negative gross margins, it automatically reduces exposure. That programmatic selling creates constant overhead resistance. Even when retail participants try to pick up fractional shares on a platform like SoFi Invest or through a basic Robinhood stock trading strategy, their collective buying power is often overwhelmed by institutional automated selling. If you look at the larger retail houses, such as those trading through Fidelity Investments or analyzing the market via the advanced Fidelity trading platform, the sentiment is deeply divided. Some view this as a multi-year turnaround play act by overseas wealth, while others look at the mounting legal liabilities and wonder if the equity will ultimately be wiped out before the product line becomes truly self-sustaining. Let us take a brief moment to step back and analyze what this company actually does at its fundamental core. Lucid Group operates as a vertically integrated luxury electric vehicle designer and manufacturer, building its machines from the ground up with a core focus on hyper-efficient powertrain technology and ultra-high voltage charging architecture. Their initial product, the luxury Air sedan, received immense critical acclaim for its industry-leading driving range and premium interior space, outclassing many traditional luxury models on peer specifications. The business model relies on direct-to-consumer sales coupled with an in-house service network, completely avoiding the traditional franchise dealership model. Historically, the company rode a massive wave of speculative capital when it
initially went public via a special purpose acquisition company, reaching valuation peaks that defied traditional financial metrics. During that period of peak speculative fervor, anyone looking to invest online or looking for the top trending assets on standard investing sites would see this company plastered across every financial thumbnail. However, past engineering awards do not pay for current assembly line operations. The transition from building a low-volume luxury sedan to mass-producing a complex three-row SUV like the Gravity has exposed severe vulnerabilities in their global supply chain. The revelation that an unauthorized supplier substitution forced a month-long delivery halt because of defective seat components is a textbook example of execution risk. When a car maker tells the market that quality control issues have been completely solved, and then an archival regulatory filing shows a total halt in deliveries during that exact same time frame, consumer and investor trust erodes rapidly. This specific event is what triggered the current wave of securities litigation. For individuals tracking their holdings on a standard Fidelity mobile app or managing their long-term retirement accounts through Fidelity IRAs, these corporate governance red flags are far more important than how fast the vehicle can accelerate from 0 to 60 miles per hour. Please take a moment right now to participate in our community discussion. Comment below how many shares of Lucid Group you currently hold in your portfolio, and state whether you are actively buying this dip or looking to exit your position at the next major technical bounce. Hearing your direct perspectives helps everyone gauge the real-time sentiment of individual retail participants across the market. When you analyze the ongoing trading dynamics on a platform like SoFi Invest or through standard Robinhood investments, you notice that retail buyers are highly sensitive to product updates, while institutional desks look strictly at the macro picture. Recently, the company rolled out a major over-the-air software update for the Gravity SUV, introducing hands-free driving capabilities, enhanced navigation with native mapping integration, and localized charging refinements. For a tech-focused investor tracking the stock via high-growth vehicle like specific Fidelity ETFs, this software update represents progress toward autonomy. This tech-forward narrative was further bolstered by an announced multi-year partnership with Uber and an autonomous technology developer to eventually deploy up to 20,000 vehicles as specialized robotaxis over the next 6 years. On paper, this sounds like an absolute game-changer that should cause the stock to rocket toward its fair value estimates, which some independent quantitative models place as high as $8.40 per share. The harsh reality that dampens this excitement is the massive capital expenditure required to scale a robotaxi fleet. Building 20,000 high-end vehicles takes enormous upfront manufacturing capital, and when your current financial profile shows an ongoing annual cash burn of multiple billions, you are caught in a classic paradox. You need capital to build the vehicles to generate the revenue, but to get that capital, you must continuously dilute the existing shareholders who bought into the company through their individual brokerage accounts. This is the exact loop that institutional short sellers exploit. They look at the high borrowing fees on an interactive broker's platform, calculate the inevitable upcoming capital raises, and build massive short positions that cap any sustainable upward momentum. For an everyday retail investor managing a self-investing portfolio, seeing a major product announcement followed by a drop in share price can be incredibly frustrating. They do not realize that institutional desks trading via professional channels are selling the news because they understand the underlying balance sheet pressures. Looking ahead toward the future outlook, there are a few distinct scenarios that could play out over the next 12 to 24 months. The most optimistic scenario relies on a smooth, uninterrupted production ramp of the Gravity SUV, coupled with an aggressive cost-cutting program that dramatically narrows the negative gross margins. If the company can prove to the public that their delivery metrics are stabilizing and that the recent supply chain failures were an isolated incident, the stock could easily catch a powerful relief rally. Such a turnaround would catch short sellers off guard, causing rapid buying across retail platforms like the Robinhood app or via active traders using SoFi active investing accounts. Furthermore, if their primary sovereign wealth backer decides to provide an unconditional debt default rather than demanding more dilutive equity issuance, it would remove the single largest cloud hanging over the current share price. This would allow the underlying engineering value of the asset to finally shine through, potentially attracting longer-term capital from conservative mutual funds, including popular options like Fidelity mutual funds. Conversely, the downside risk remains incredibly real and highly punitive for those who overallocate. If the ongoing class action lawsuit uncovers deeper internal knowledge of product defects that executives deliberately withheld from public filings, the legal liabilities could severely impair the remaining corporate cash reserves. A prolonged legal battle combined with a slower than expected manufacturing scale-up would likely force the share price down toward the historical lows of $4.47. Under that scenario, automated wealth management algorithms such as those governing Schwab Intelligent Portfolios or other online investment advisory systems would likely flag the asset as an unacceptable risk, triggered by a critical breach of safety margins. This programmatic capitulation would force the stock into a challenging territory where retail fractional shares and basic online investing enthusiasts would not have enough aggregate liquidity to stabilize the falling price. Investors who look at high-flying tech successes like Nvidia stock often forget that manufacturing physical automotives is one of the most capital-intensive, logistically unforgiving businesses in the entire global economy. To cleanly summarize everything we have looked at today, the entire trading thesis around this asset is a constant battle between immense long-term tech expectations and brutal near-term operational realities. The expectation is a well-capitalized luxury electric vehicle brand poised to secure a massive slice of the premium automotive market and the future autonomous robotaxi number. The reality is a company dealing with severe quarterly revenue misses, an active and dangerous securities lawsuit over hidden delivery halts, and a persistent need for equity dilution that continuously punishes loyal retail backers. While the short-term 4.28% gain on our last active session to $5.36 provides a momentary breather, it does not alter the massive structural hurdles that management must clear before the July legal deadlines. Whether you are executing a precise short-term option strategy via interactive brokers trading or simply holding a few shares on your personal Fidelity broker's mobile dashboard, you must keep your eyes fixed firmly on the hard production numbers and cash runway metrics rather than the corporate public relations statements. True wealth in the market is built by accurately separating product type from structural balance sheet health, and this asset will remain the ultimate case study in that ongoing discipline.